Hello everyone and welcome to our global webinar this afternoon or this morning if you're in the States, and we're proud to present our report on the global euro. I'm Chris Turner, I'm head of research here in the UK and also for financial markets research. You may be asking why we have released this report today, and it's been 100 days since Christine Lagarde said Europe should take advantage of this global euro moment. The euro should really sort of take this opportunity to earn its fair share of global capital, given kind of the breakdown perhaps in the international finance environment that we were seeing, particularly after events in April. So I'm delighted to say we've been joined by four of my great colleagues today, and I'll introduce them here and now. We've got Dmitry Dolgin, our CIS economist, chief CIS economist. You've read some of his work on de-dollarization in the past, so that's Dimitri's speciality here today. Enjoyed by Ben Schroeder as well, our senior rate strategist based in Amsterdam. Also by Marine Leleur in, I think, Amsterdam as well, right? And in terms of sector strategist for financials. And Michiel Tucker as well, our senior European rate strategist, which have all helped on the report today. So we'll be talking for the next 30 minutes over the contents of this report. We're going to try and keep it interactive as well with questions. A little bit of housekeeping. We'll present for about 30 minutes with a few questions, and obviously we'll introduce some charts as well. If you've got any questions, please submit them via the tab. This is a public domain, so please don't share anything you don't want to be seen kind of publicly. But first off, let's start with a question, actually, because Christine Lagarde, in terms of her metrics, in terms of how successful the euro should be, she likes to look at this statistic, which is the euro is used as 40% in global trade in terms of kind of invoicing to some degree, but it's only represented 20% in global FX reserves. Why is there that difference? Why isn't the share higher? So let's start off with a question then, and we're going to be asking, so the euro currently makes up 20% of central banks' FX reserves portfolios. And what will that share be in 5 years' time? So hopefully if the question can appear on the screen. We've got options here. So it's 20% at the moment. So in 5 years' time, is it going to be under 15? It's gone the wrong way. A little bit lower, 18 to 22%, about where we are now. Bit higher, or you think this is really the end of the dollar as we know it, and it's the euro's time. Let's see where that's going to go going forward. Oh, I've got some interesting results already. Slightly kind of positive. Yeah, clearly positive, I would say. So that's a great opportunity to bring in Dmitry now on the subject of FX reserves. So, Dmitry, we know you've written a lot about this in the past, that the euro share has been creeping a little higher. We think we understand that the BRICS, given what's happened with frozen assets, would like to reduce their kind of share of dollar and FX reserves. I mean, what are your findings so far in this report?
Yes, thanks, Chris. And also, I'd like to start with saying that it's great that our audience is euro optimists, such as we are. So in terms of data on reserves, in short, the data tells us two things. First, it might take some time before we see some tangible progress with the euro share, but the long-term potential is definitely there. The second takeaway is that the potential investor base for the euro, much like for the other non-dollar assets, among central banks could be actually broader than initially believed. So let me just briefly elaborate on those 2 points. First of all, in terms of euro's progress so far, as you mentioned, euro remains the second most popular reserve currency with around 20% share. And to boost this share this year might be a bit challenging because a number of central banks from emerging markets in particular seem to be busy now replenishing their dollar reserves after intervening heavily last year. But in the longer run, the general de-dollarization trend is definitely there. And even now, if we switch our focus from quarterly dynamics to annual, meaning year over year, we see that euro holdings are still up by 71 billion euro, while dollar is down about 53 billion. So the diversification story remains in place. Now, secondly, in terms of who's doing what, the interesting shift is who is doing the non-dollar demand, including the demand for euro. For years, it was the very large reserve holders diversifying their so-called investment tranches. It's the BRIC countries that you mentioned. And they still have the appetite, especially given that most of the BRICS were slapped with either US sanctions or elevated US trade tariffs of 30% and more. But what's particularly interesting and new is that now we're seeing smaller reserve holders, a group that's steadily growing as a share of world reserves to 31% currently, also seem to show a higher appetite for non-dollar assets, especially euro. It was previously believed that smaller holders didn't have the luxury to diversify and had to maintain high share of dollar for liquidity purpose. And yet, over the last year, these smaller players seem to have contributed greatly to reserve diversification, while the top 10 holders, who still control around 70%, 69%, also participated in this, but to a more modest extent. So in terms of what to watch next here for second quarter, for example, which the data for which is still yet to be sort of released, our country level read suggests global reserves overall rose, with smaller holders again contributing, and the rest split across large holders, BRIC and non-BRIC. And that still looks like a continuation of this sort of pause in de-dollarization, but it's not a reversal of the long-term de-dollarization trend. So to sum up, the data shows a temporary pause in de-dollarization, but not a reversal in the trend. And euro usage is still up on annual terms, and smaller reserve holders are emerging as noticeable buyers of non-dollar assets, including the euro.
Okay, that's great. And so, Dimitri, we know that countries want to spread the use of their currency and the benefits, right? We'll talk later about kind of lower borrowing costs, but they like to do that by making sure the currencies are used in invoicing, right? And that's why central banks, like not only the ECB, particularly China, is extending all these kind of swap lines for like invoicing. Is there anything new in the data on invoicing for the euro?
Yes, in payments data, the shares of the key currencies, which are dollar and euro, so far they look sort of range bound. If we compare current data as of July to the beginning of the year, US dollar is steady around high 40s in terms of share, euro is behind. And that seems to correspond well to what's happening with the global trade geography. So more specifically, if we look at the SWIFT transaction shares, this proxy for cross-border payments, the US dollar sits around 47, 48% year to date, while euro is around half that. So no big breakout yet. Both are basically range bound. And this year, after SWIFT's methodology tweak back in 2023, this dynamic seems more or less flat. So the two key takeaways is that dollar's vehicle currency role is still very strong, and the euro share is stable but not sliding. We should probably sort of mention here that SWIFT is, of course, not the only source of invoicing data, but so far it's still the most representative in terms of transaction volumes and therefore overall trends. So why the stall in the euro's share? Well, partly it's trade geography. Since 2020, the euro area's share of global merchandise trade has sort of edged down, while the US actually, and surprisingly, has leaned into tighter regional links with close neighbors like Canada, Mexico, and the post-Brexit UK. So payments tend to sort of follow trade. So you see it in SWIFT. That said, policies can move the needle on invoicing, on swap lines, on lowering transaction frictions. So the near-term levers in this regard for the euro area should be like policy and geography driven. Basically, it's a question of where Europe trades and how to lower the trade frictions.
And on that subject, Dimitri, in terms of like where Europe trades, so, we talked about kind of invoicing, but also, if we look sort of geographically, where Europe should be trading, where it could hope to spread the influence of the euro. I mean, you've got some like interesting studies on that, right?
Indeed. It is a very valid question where are the near-term trade and invoicing wins for the euro. And we believe that actually this US tariff story, this tariff shock, could actually create some opening for currencies like the euro. If, of course, Europe manages to make deals with in the areas where economic gravity already favors it. Importantly, to the countries that were slapped with the highest US tariffs, so as I said before, 30% or more, it's up to 50%, I think, and that includes several BRICS countries and Switzerland. So to those countries, euro area is either already equally important trade partner as the US, or those countries have currently weaker ties with the eurozone than the sort of physical distance would suggest. So by that measure, India and Switzerland seems like a realistic near-term boost for euro, for basically trade with euro area, which could potentially lead to higher invoicing in euro as opposed to dollar. And conveniently, and maybe not entirely coincidentally, EU is currently in trade negotiations with both, and there are hopes there that those negotiations could be finalized this year. Another sort of practical near-field opportunity is actually the UK, because there is some scope to restore some of the trade with the EU that was sort of lost and repurposed towards the US after Brexit. And finally, there is actually a large and very important group of major Asian economies like Japan, Korea, Taiwan. They are they could be seen as a more remote opportunities, but with existing EU trade agreements, there could be some scope for the euro to sort of use the recent tariff shock as a competitive edge over now more protectionist US. So to sum up, Europe could focus on winnable markets first. It could be India and Switzerland if deals land, then post-Brexit UK, and then basically keep progressing in Asia, in Asian majors with existing agreements. And the policy tools there are trade, payments, swap lines, basically to make euro invoicing the path of least resistance, so to speak.
That's great. Many thanks, Dimitri. Very interesting. So these are some of like these longer term structural factors. I'm just going to touch on one another of those right now in terms of some data. And we've used that in our de-dollarization reports before, which is this issue of, if you think about where the dollar kind of earned its status as the world's reserve currency, it was really between the wars when the US started lending out so much money to Europe, denominated dollars, and requiring Europe to hold dollars to service that debt. So what we think is international debt issuance and those trends and the currencies of those trends are really important. And in the report, we reference something that emerged last week, which was Kenya, which is switching its dollar financing to renminbi financing its external debt. Now, you could say that's just a function of kind of cost, but it also feeds into China's desired expansion. In the same way that Lagarde is talking about a global euro moment, the Chinese will be talking about a global renminbi moment and wanting exactly the same, the lower borrowing costs and the greater clout in the international space. So when we look at international debt securities, the euro issuance has been growing, brilliant, but so has dollar issuance as well this is, I think, up to the first quarter of this year. So again, slightly old data, but it's all heading in the right direction. And over time, we would expect, and I suppose hope, being a European bank, that the euro share would grow over time. The share hasn't changed much at the moment, but certainly heading in the right direction. And in terms of, I think, the very strong issuance levels for European debt, not only in the developed market space, but particularly the emerging market space as well. We've got some nice charts in the report about emerging sovereign issuers and increasingly issuing in kind of euros. So that's one of like the longer term structural factors that we'll be coming back to over coming quarters as well. But I suppose you could say you're looking at the global euro in 100 days. What really could you expect to see? And that's when we move to the shorter term and we look at data that comes out on a monthly basis. So, for example, the ECB's balance of payments data, which will show foreign buying of Eurozone debt and equities. So if we look at that data, actually, that's been pretty healthy. May and June saw some very strong data. We can sort of see it here. If you look over on the kind of right-hand side here, kind of very welcome, helping to keep sort of borrowing costs relatively low in Europe. Now, my colleagues will discuss that a bit later, and also providing some healthy support for the euro. So we're going to monitor this. So in aggregate, it's looking pretty good. But I think what we really need to do now is to drill down in some of the particular asset classes, and particularly, I think, fixed income, because we want to talk about sovereign debt. We want to talk about the euro as a safe asset as well. So I'm now going to bring it over to Michiel to tell us about developments in the government bond market. So Michiel, how would you like to start off?
Yes, I should be good now. So for government bonds specifically, we've seen quite healthy demand over the past years. So government bonds are the biggest bond market in Europe, about 11 trillion euros outstanding. So that's quite huge. And if we look at the data a bit more deep on a chart, we can see that now about 22% is held by foreign investors. So that's the brown line that we see, which is up from 19% that we saw around 2022. But if you look at the bigger picture, there is still scope for a further increase of foreign investment into bond markets in general. Because if we look at the levels that they were in 2015, we can see that government bonds were actually held for about 30% by foreign investors. And also, if you look at it from the perspective of, for example, US Treasury, which is another huge bond market, the biggest one, there the foreign ownership is around 34%. So you can imagine we're now at 22%. If that nudges up, and because we're talking about 11 trillion, every percentage point has quite a big impact, 100 billion, then there's still a lot of scope for further buying from foreign investors.
Are we seeing an inflection point right now? I mean, what would really give you greater confidence that, yes, investors are bracing this sort of global euro, have greater comfort in holding Eurozone debt?
Yeah, so if we zoom into the flow specific to Eurozone government bonds, we see that foreigners have especially played quite a large role in absorbing the additional supply from quantitative tightening. As the ECB has been unwinding its balance sheet at more than 300 billion euros per year, foreign buyers were actually the one that stepped in as an important buyer. So we can see that as the ECB continues to unwind their balance sheet, that's also where we can expect foreign investors actually to play a very large role, if not the biggest role. And if we look we zoom even further in, because as Chris mentioned, what has been achieved really over the past 100 days, we can see that the foreign buying in May and June was actually at a record for the strongest in a year, 50 billion euros per month. Having said that, of course, early in the year was a bit disappointing, but that does say there is strong demand from foreign buying. Too early to talk about a trend, but it's something that we're monitoring quite closely.
Okay, that's really interesting. I think it's now about time for another question. Because we're going to move on to this idea of safe assets, right? And I think one of the challenges for Christine Lagarde is when she mentions the phrase safe assets, that people think of fiscal union, and Northern Europe is not quite ready for that yet. But on that subject, if we could put the second question up on the board. So we're trying to answer the question. So instead of EU's project bonds, so after the pandemic, they came out with these project bonds, targeting, I think, sustainability into digital infrastructure, which had a limited life expectancy. Also now with this shift to growing defence and independence of defence in Europe, we've got these safe assets being issued now. They are going to kind of roll off over time. But what would we say about, is the EU ready to build out its longer term presence in the joint debt market, such that it can be included in some key indices? So anyway, looks like we're getting some interesting answers there, and some quite optimistic, surprisingly. Oops, it's changing quite a lot. I just saw a 60% yes, and it's just swung around. So let's look at that quite carefully. But no, I think that's one of the challenges that hopefully we'll hear a bit more about now from Ben. So Ben, first of all, what would you say about the subject of kind of And let's focus perhaps on the bunds. And is there any signs that bunds are playing the role of safe asset, or what do you think?
Yes, I will come to that, but it's great to see some at least guarded optimism on the EU being able to kind of making use of that opportunity. And basically the backdrop to that question is, can European bonds expand their role as global safe assets? And recall after Liberation Day, we had this brief breakdown in the usual market correlations, which gave us the sense of selling America. And if US Treasuries are no longer the safe asset, can Europe fill that gap? So maybe just let me start with some basic numbers to highlight the opportunity that is opening up for Europe here. So if you just look at the global AAA bond pool, and this has actually shrunk quite considerably since US Treasuries dropped off when the last of the major three rating agencies, Moody's, stripped the US of its last remaining AAA rating in May this year. So we are down to 9 trillion in global AAA bonds now, 20 trillion less than it used to be. And we are actually seeing some effects of crowding into that remaining AAA pool. We kind of see that, for instance, AAA KfW dollar bonds and dollar EIB bonds are trading close to flat to US Treasuries. And usually there would have been a bit more of a premium involved just because of the superior liquidity of US Treasuries. But if you look at this remaining pool and look at the chart here, you see that in terms of currency split, we now have actually 55% of those remaining AAA bonds in euro-denominated bonds. And again, 20% is actually German bonds, 7% is EU bonds. So if you are an investor seeking a AAA bond specifically, you'll probably find few ways around euro-denominated paper. And the basic question is, can Europe really step up and make use of that opportunity? And you could argue in one way already does. Germany has opened its door to a large fiscal stimulus this year and expects to raise around 850 billion in new debt over the current legislative period. And how did markets react to that? Actually, they took it relatively well. So if you look at the 10-year Bund, it is trading now around 25 basis points above the quasi-risk-free OIS rate. And that compares to levels of around 50 basis points for US Treasuries or gilts. So the market does appear to be able to really absorb these amounts. But of course, the big discussion now is, will we see also more common issuance by the EU, for instance? We have the existing EU programs that Chris, you just mentioned. And in the near term, these the outstanding volumes of these bonds are likely to increase as the remaining support from the NGEU program, for instance, is dispersed. And then, of course, we have this safe instrument to support the European defense efforts, where 18 countries have signed up to, and this is amounting to around 127 billion. But still, these are only temporary programs. And the question is now, what comes beyond that? And actually, as of 2028, NGEU debt will be paid down by around 24 billion annually. And this is actually according to the EU Commission's own long-term budget plans, the proposal for 2028 to 2034. And so this is already kind of pointing to a contraction. The Commission did put into these long-term budget proposals plan to create a permanent crisis mechanism with a firepower of 400 billion, a loan facility with a volume of around 150 billion to finance EU objectives. And there will probably also another large chunk that needs to be financed to support the Ukraine. But the main question is, will we really get any of these new facilities or proposals? And this is still a highly political decision to be made. And the negotiations for the long-term budget, they have just begun, and they will probably only conclude at the earliest next year, and can easily get stuck and run through much longer. And so far, the majorities for such new mechanisms are far from certain. And in fact, we've only seen pushback so far. And yeah, if you really want to establish the EU as a permanent issue, as a sizable issue, you also have to think about the own resources for the EU. And currently that is mainly just member state contributions, with a small share of EU customs revenue in there and a small share of member states' VAT revenues. But also this debate on own resources has so far been blocked by the member states.
Okay, great. Really interesting indeed. Thanks a lot, Ben. And got quite a few questions coming in on those subjects, which we'll get back to at the end. And in terms of our scheduled block now I think more directly, Ben's touched on it, but move on to the politics, right? The reforms. Christine Lagarde has talked about the fragmentation of Eurozone kind of asset markets, how to address that with structural reforms. How do they try and do that? And that's why we've got Maureen joining us today. So Maureen, has there been any progress, or what should be the key markers we should focus on in terms of if there is progress in terms of some of these structural reforms?
Yeah, thanks, Chris. I think on those topics, there's actually two main points. The first one is the Saving and Investment Union, and the second one is the digital euro. So if I start with the Saving and Investment Union, the SIU, otherwise put, it started earlier this year, where basically the project was announced, and it included the consolidation of what is currently a very fragmented European capital market. That's not a new question. Of course, for over a decade, the EU has tried to finalize its capital market union with not much success, because there's very deep cleavages between countries in the EU on several topics, including, for example, tax law. So what changed is actually the Draghi report, of course, put back this question of capital market consolidation on the front page. And what it translated into is the Commission's proposal for SIU. And what is included, it's basically a very large number of action points on a wide variety of topics that go from securitization to retail investments. And what we see with all this very high number of action points is really the EU's willingness to act on those consolidation topics for the capital market, but without actually reopening the more contentious points that were existing for the capital market union. So what it includes for this year, basically, it's 7 action points from, if I look at the Commission's agenda, that's a very large number, and we have already seen one topic come out. It's the simplification of the securitization framework. It's out, and we're waiting for the Council and the Parliament to come up with their opinion on it, and that should come in the coming month. And then there are 6 other topics that still need to be addressed this year, if you look at the agenda, and one of those is coming in next coming weeks, in the third quarter, and that is on accounts and saving accounts and investment accounts. Basically, what is important here is looking at this number of action points, and focus from the EU is really the willingness to act on this consolidation of the capital markets. But what it also means, it's that they're doing it fast, they want to act now, but it also means that we're on a really early stage of the process. It's more of an ideation phase, and to see result and to see some things change on the regulatory side, we'll have to wait a couple more years, and in some topics, maybe early next year also, but that's a long process. So that was for the first part, the SIU. Now, if I turn to the digital euro, I think that's definitely something we're going to see in the news way more in the coming weeks. That is because there was a preparation phase that lasted 2 years, and it's actually ending in October. And what it means is that the ECB will have to decide if it wants to continue the project, or if it's more about how to finalize the project, in my opinion. But also, if the decision is positive, what was announced was a 2 to 3 year time span to actually launch the digital currency. Now, aside from these deadlines, October deadline and the 2 to 3 year timeline, I think what is more interesting here is how the project is actually presented. It has changed massively over the course of 2 years. If I look back at 2 years ago when the preparation phase started, the main argument really was on technology, on the fact that we needed cash on the digital space because cash use dropped in Europe in all countries, literally. Now, what we see now is that this technology argument is really relayed to the background, and the main focus is really on what is called EU's open strategic autonomy. That just means that because cash use is reduced and at the same time we don't have an equivalent on the digital space, we are seeing a heavy reliance in Europe on digital payment system. And the problem is that those payment systems are not European, they're non-European, but most importantly, they are US payment systems. And that is presented really as a strategic and sovereignty challenge by the EU, and is really brought to the front lines in this digital euro project. And they're saying that a digital euro could solve this issue. Now, there's also recently been a sense of urgency because the US passed its Genius Act on stable coins, and there is some reports on EU official trying to push to finalize this digital euro project faster. I'm not entirely sure if this actually is going to translate in a change in the timeline, if we're going to see it being launched earlier than 2 years. Mostly because there are some pretty big questions that are still flying around on this topic. The main one being the bank's deposit safety net and the holding limit for those digital euro. And those questions are still open and they need to be answered before we can actually see it happen. So basically, if I summarize, the digital euro is actually going to be very much on the news in the coming weeks, but there's quite some open questions, and it's for the moment it's still a project, and we first need to address those questions before it will materialize into something serious. But that's where I'm going to stop for today. I'm actually going to hand over to Chris.
Thank you. Great. Thanks very much indeed, Maureen. So that ends our sort of formal presentation section. We're now going to go to some Q&A, and please say we've got some interesting questions. A couple regarding, obviously, the safe asset and a few about kind of currency and reserves. So I'm going to start off. Ben, I'm going to start off asking one to you. A gentleman, I believe, yes, a gentleman says, really, what could an increase in euro-denominated debt or EU bonds mean for the EU economy? One should probably argue against more government indebtedness. I suppose a bit of a general remark, but I suppose, yeah, how would you try and answer that?
So the argument is to basically create an EU safe asset, so highly rated EU bonds that would come with some, cost saving. I mean, you also have to make the argument that on aggregate, the debt level actually has some room to still increase for the Eurozone. It's still that there's some countries which have the room to increase and are not using it or are now starting to use it only, and that some others don't have that leeway. I mean, look at Italy or France. So I guess the creation of a safe asset would more go towards the cost saving side that comes when financing in these types of bonds. I probably leave it there for this.
Okay. Just while we've got you, we're going to ask another question relating to like the safe asset, and we have a question which is, do you consider justified that EU bonds will be rated AAA, considering that only Germany is rated AAA among the 4 main Eurozone countries at the moment? What do you think, Ben?
I guess, I mean, how do rating agencies derive that AAA rating? They look at the budget contributions from these highly rated countries and see whether they cover basically the redemptions over the next years already. And it's not only Eurozone countries, but of course there's also other countries in there, Sweden, for instance. I guess if you were to really expand the EU issuance, even under current circumstances, you would have to think about giving the EU probably its own resources other than membership contributions to perhaps keep at this or make it easier to maintain this high rating. So streams of own income, be it on bigger share on the VAT or carbon trading, things like these have been proposed. So I think if you kind of expand the own resources, then it could be possible. But yes, there's some limits to how far EU issuance can be expanded while maintaining the rating under the current construction, I'd say.
Okay, great. Many thanks, Ben. We're now going to turn back to, I think, Dimitri, a point you made, one of the first points you made, but a question coming in from one of our friends in the journalism area. So in terms of reserve diversification, Dimitri, can you explain a bit more about who those smaller reserve holders are? Are they concentrated in a specific geographic region? Do you have any observations which could support why they're looking to diversify? So yeah, a little bit more about that interesting angle in terms of the geographic mix of reserve changes.
Indeed, very good question. Thanks. So basically, small holders are all but the top 10. So the top 10 holders that collectively control around 70%, 69% of the world's global reserves, those are BRIC countries and other large developed market countries such as Japan, for example, and Singapore, Korea, and a few others. So all the rest in the database that we sort of track, we track individual country level data for 100 countries. So to us, the small holders are basically 90 countries, and they're not specifically concentrate in any area. And the cutoff here is basically each of those countries have the share in global reserves, which is lower than 2%. So 2% is what gets you in top 10. I would only add here that looking at which particular of the small holders, of the smaller FX holders, contributed to the increase in the reserves overall over the last year, it's actually quite a broad and diversified group. So as an example, we have Poland, which actually naturally would be, I would assume, given its trade ties, could potentially contribute to the high demand for euro. But there are also others. For example, in the Americas, Mexico boosted its reserve over the last year. In Asia, it's Thailand and Indonesia. There were a few others. In terms of how we sort of come to the conclusion that they are the source of the demand, it's basically cross-referencing the changes in the country level reserves over various periods with the changes in the overall FX composition. So in the chart that we showed, which shows like the change over the last year, the key contributors to the changes in the overall reserve levels that we saw, it was by about I think a couple of $100 billion. Only the small holders were actually contributing to that change. And within that change, we also see that actually there was a further diversification away from the dollar. As I said, the dollar denominated reserves dropped by around 50 billion, and non-dollar reserves, mainly the euro, they actually increased.
Thanks, Dimitri. While we've got you, I'm going to ask another question, kind of related. It's relating to FX reserves, but the question is: this summer, gold outperformed the euro in global reserve holdings for the first time since the euro crisis. What does this tell us about how central banks view the euro as a safe asset? I suppose a slightly negative interpretation for the euro.
This is a very, very accurate and pointed question. Many thanks for that. With the share of euro but more importantly gold in the reserves, we have to be extremely careful, because the headlines that we see, they reflect the dollar value of the dollar. So so the share, I would say, of gold in reserves is significantly inflated over the last several years by the basically the increase in its price. In order to accurately calculate and assess the preference of the central banks, we have to sort of adjust these numbers to sort of assumed fixed price of gold, and also assume the same in terms of exchange rates to sort of compare this FX adjusted international reserves in general, which includes foreign currency and the gold. So actually, if we do that exercise, we can see that the actual share of gold, like physical gold, in the reserves has been flat at around 20%, 22% over the last actually 15 years, since 2011. So this doesn't mean that the central banks are not buying physical gold. They do. We see it in terms of like thousands tons of gold, but this buying goes parallel, and only to the same extent the foreign exchange reserves are increasing. So yes, indeed, gold is a competitor to euro. Its share is pretty close to euro in that sense, but I wouldn't agree that euro is currently losing in investment attractiveness compared to gold. It's a right. Stable relationship.
Okay, that's great. Many thanks, Dimitri. And we're going to further stress test the idea of the global euro and the safe asset. We're going to ask a question to Michiel now, if that's okay. And we've got a question. As a global safe asset, do you not think there's a degree of complacency towards the euro, given the fundamental breakdown in political consensus or a significant crisis in governance, alluding to France and to some degree Germany? Tricky one.
Yes, definitely. I think I'm not going to deny we do have quite some challenges in the Eurozone that we're facing. But also, doing a step back, if we look at a global level, we see very similar issues elsewhere. I mean, the United States don't have to cover. You see Japan is figuring out how to navigate their fiscal problems. The UK being in the spotlight at the moment, with the autumn budget being presented. So markets often look for the weakest link. And I think had this happened... Has this development in France happened another time? Yes, there would have been maybe a bit more punishment from markets towards Europe, but maybe it's not the weakest link at the moment. Secondly, I think markets also quite aware that reforms are being rewarded. And that's what we see with the defense spending announcements, that actually you saw spreads coming in tighter rather than wider, even though that meant a lot of fiscal spending happening. And I think markets are quite content to see that Europe is trying to push towards reforms, whether it's defense, infrastructure. It's not an easy one, I won't say that, but I think the momentum in the right direction, albeit it being slow, is something to acknowledge. And I think that brings me to the third point, that even though what we're seeing in France at the moment, we do at the same time have some success stories from Spain, from Italy, where you see spreads are a lot tighter than they've been before. So it shows there is this resilience as well to bounce back out of a very difficult position. And I think the ECB will also, in markets' mind, play a big role in this. There are instruments the ECB can resort to make sure that borrowing costs don't spiral out of control. Maybe they never have to use this. Maybe it's markets already pricing in the ability of the ECB to use it. And by doing that, there is already an avoidance of borrowing costs spiraling out of control. So even though completely agree, there are hurdles, we might not be the worst positioned at the moment in Europe. And I think there are also some reasons to be optimistic based on where we've come from the Euro sovereign crisis before.
Okay, many thanks, Michiel. And let's have the final question now, still for you, Michiel, if that's okay, especially because it's so relevant given this week's developments. But Question, what is the House view on the recent bond market sell-off? Do you expect this to be sizable long-term headwind for the euro? Well, maybe it's a question on the FX as well, but in terms of, let's get to the bottom of the bond market sell-off first, but driven by French political turmoil, or do you err on the side of a swift, amicable resolution, presumably applying sort of French politics? So yeah, what's a difficult one again? What's a quick view on French politics, I suppose?
Yeah, I think it's first of all, it's very important to acknowledge that a lot of the headlines we're seeing are about 30-year yields going up. So really all the way at the back end of the curve. And that's not a Europe specific thing. We see that in the US, we see that in Japan, we see that in the UK, same countries. So part of this is supply and demand, simply the idea that we will get a lot more supply from these fiscal expansions that are happening. And at the same time, it's also demand. So we see some more idiosyncratic factors, whether it's Dutch pension reforms, whether it's pension reforms in the UK as well, that simply reduce the demand for these long-dated assets. So from that perspective, yes, we could see yields rise further from the very long end. But I think it's not as worrying as a credit risk event per se. If you look at rates a bit shorter, so say 10-year rates, then also you see a rise there. But there's also positive stories to say about that rise. So if you look at 10-year swap rates, bond yields as well, they're also rising with the expectation that growth is recovering, with the expectation that we will get this fiscal impulse coming from Germany. So it's not all doom and gloom how we would describe the sharp rise in yields that we're currently been seeing.
Okay, great. Well, we're still actually getting questions. So if you guys, our viewers are happy to stick with us, we might as well continue with answering a few questions. Got one on BRICS currencies. So let's go back to you, Dimitri. So can BRICS currencies become more important in FX reserves than the euro?
Thanks for the question. I think that BRICS countries have a lot of influence on the de-dollarization and the process of this global shift in the currency structure of the reserves, because BRICS countries control around 43% of the global international reserve. It's mainly China, which controls 30%. In terms of trade, they control more than 20%. So that's more than Euro area or US taken separately. So there is a great deal of influence there. But in terms of their own currencies being able to seriously compete with developed market currencies such as dollar and euro, seriously doubt it. There are two main arguments against it. First of all, 30% of the reserves are held by China. What kind of currency China would hold as a reserve currency? If it's not CNY, then what is it? What is the viable alternative? And it cannot hold its own currency as a reserve currency. The second, and I think more important argument against it, is that in order to be able to offer your own currency as a sort of reserve asset, you have to have a very deep debt market. You have to offer some assets. You have to basically issue a lot of debt that other countries could use it as an asset. And the US, with its $25 trillion in US treasuries, and Euro area or European Union with its more than 10 trillion euro in sovereign debt, they are capable of providing it. With the BRICS Plus, they account for less than 5% of the global external debt and around 3% of international debt securities market. So with that kind of volumes, I doubt that in the near term we can see any of their currencies as a significant and serious alternative to the main ones.
Brilliant. Thanks so much, Dimitri. And a final question, one for you, Maureen. So what are the expected effects of introducing the digital euro on the use of the single currency? Would its implementation guarantee European sovereignty vis-a-vis American payment systems?
Yeah, those are a very good question, actually. I would say there's one very important variable here, and it's the acceptance rate. And that's something we don't have much of actual use case to look at and to estimate. But of course, if the digital euro is very widely used in Europe, in the Eurozone, it is expected, or some research has shown, or expected timelines has shown that it could be used, especially in Europe but non-Eurozone countries, as a digital currency to trade within the with the Eurozone in and out, and for travelers, etc. But that's, of course, very reliant on the very broad use of the digital euro, and also that it kind of replaced the other available payment methods that we already are using in Europe and are quite good and well functioning here. And that is also the answer I would have for the second part of the question, is it really guaranteeing Europe's sovereignty vis-a-vis American payment system? Well, it's a bet. It's not sure. Again, the variable on the acceptance rate is crucial here. And it's also difficult to estimate because, as I said previously, there's some variable and some questions that are still open on the project, especially on the holding limits. And there has been discussion on whether or not a low holding limit that would actually protect banks' deposits would hinder the use of the digital euro, because you cannot use it as much or for so many things and to buy so many things. So there's a lot of variables to take into account here, but the main one, of course, is the acceptance rate, and that's really what is going to make or break this project. And that's something that we'll have to see when it's live, because we currently only have 3-4, if we count the Chinese pilot phase, currency that are out, and the acceptance rates and usage rate is very low in those countries, but those are very different economies. So it's a very good question, but it's, unfortunately, that's the answer I have. We'll have to wait and see, and also see in the next step what are the answers to those questions that are still hanging, including for the holding limits.
Brilliant. Thanks very much indeed, Maureen. And so that's the end of our presentation and the Q&A. We have had a request from a customer whether we can share the slides. We can't do that in this format here, but please, if you go to our website, www.think.ing.com, you can see our full report there. It's like a 20-page report with a lot of these kind of great graphics that the team have put together. So I'd very much like to thank you, the viewers, for spending up to 50 minutes of your valuable time with us. And I'd very much like to thank my colleagues for doing an excellent presentation this afternoon. So we'll see you again soon, and please let us know with any feedback or questions you have. But we'll leave it there and see you again soon.